You don't have to be a genius to be good at investing. Just get a few things right and you can achieve it. There's no limit to the upside.
Do you remember over the 32-year period how much you roughly invested?
And I found that quite difficult in my 30s to sort of put away very much. People have become ISA millionaires putting in close to the maximum amount of money. I was able to do it by putting in less money.
It's about 6,000 a year. It's not a hefty
And that was
amount.
skewed towards the end of that period because in the early part the limits were much lower, only £6,000. The earlier you start that process, the more eventually it will add up to.
Many people don't think it's possible to beat the market. What's your take on that? Do you think it is possible?
People tend to suffer from irrational exuberance and get carried away to the upside and being too depressed about things on the downside. And you can't dominate the market. You can't tell it, I want to be a millionaire by this age and it will deliver. You've got to also accept that you might be wrong.
You reached ISA Millionaire status in 2013. What's the story behind how you actually got there? Welcome back to another episode of the podcast. I'm your host, Atto. We've got a special guest in the building. This is somebody who's quietly achieved what many investors only dream of, turning a regular ISA into a portfolio worth over £1 million. Leon Boros is a former corporate financier, former share stock director and private investor, and has been investing for more than 32 years. Leon, how are you doing today?
Really well, and thanks so much for inviting me. I've seen some of your other podcasts. They really impressed me, and I thought, I want to be on that show.
Thank you. That's very kind of you to say. You don't have to say that, but that's very, very kind of you to say. I'm very much looking forward to this conversation because you've achieved something that not a lot of people achieve. It's a very rare achievement, and a lot of the audience is interested in investing and understanding how they can kind of use investing to achieve their goals. So I wanted to start with this question. Looking back over your life, what moments or themes do you think have made you the person you are today?
I had advanced warning on that question, the only one, but and I probably needed it because I gave some serious thought to it. And I suppose the kind of driving force, I suppose, has been the fact that I come from sort of ultimately an immigrant family. My great-grandparents came from Eastern Europe at the end of the 1800s. And my father, he escaped from Hungary when they had a revolution in 1956 and came to the UK. And from my father's side. So both sides of the family came here with absolutely nothing, penniless, and yet they made something of their lives. My father had a successful retail business that my brother and my sister are still involved in, and my grandparents as well had successful businesses. And these aren't huge businesses, but given from where they started with zero, it's impressive. And I suppose that puts a certain amount of pressure on you. I mean, the good thing is you're born in an environment where people are talking about business all the time. But equally, you're conscious that, you're the next generation and that you need to sort of do something and achieve something. My father was always quite tough with us, my siblings and I, and we were expected to do things. That sort of tough love, I probably didn't appreciate it at the time, but certainly gives you a certain drive. And I've always been naturally competitive. So I suppose they were the ultimate factors that sort of drives you. And then I suppose you've got to look at your own personal qualities and skill sets and think, well, how can I best how can I channel it the best? And my father wanted me to go into his business, and I was refused. And I wanted to go my way. And I did a degree in economics, then studied to become a chartered accountant. I found the things that I was naturally good at. And I'm a great believer in that. Always play to your strengths. I keep telling my own kids, play to your strengths, and then that will give you the confidence and the happiness as well when you're doing well at something. And sometimes in society we're too busy trying to make people go down the same channel, and actually you end up with a lot of discontented people. So I suppose that's been the driving force. I wanted to succeed. I was naturally competitive, and I had a natural advantage, I suppose, in growing up in an environment where there was lots of talk about business.
Okay, so you felt like that environment of where it was just a normal kind of conversation. What kind of conversations were you kind of having? It would be nice to know so that other people can have that conversations with their family and open that up.
Well, I don't want to sort of elevate the level of conversation too high. Thinking about my grandparents, they would be discussing the people who've been in the shop during the day, but equally at the lowest level, and at a higher level, they might be discussing, well, should they open up another shop, or should they be buying a different range of products and augmenting what they were selling? Right. And then, some of my great aunts and uncles, and I had 17 in total across the two sides of the family. Wow. And some of my uncles, they were quite creative people. They were always thinking and coming up with ideas. I don't know if they were always that practical and they were that good at making things happen, but certainly the discussion about, ideas and taking a small idea and making it a big one, that was always a theme. That was a helpful advantage, I think. Yeah.
What do you think? Why do you think they went into entrepreneurship and business, especially because I feel like in the UK, it's not right now. It's not that popular. Yeah, it's not like compared to America. Yeah. But what do you think made them have the drive to be like?
Yes, I've thought about that. I mean, I suppose going back to the late 1800s and early 1900s. My grandparents both left school at 14. My dad came over here when he was 20. So, and he didn't speak English. My grandparents obviously could speak English because it was their parents who'd been the first people that came over here. But I suppose there was a feeling that you had to go where it was easy. And in those days, retail wasn't as concentrated as it is today. So they could get involved. Rents weren't as high, and they could actually, it was a good way of getting involved in the wealth creation process. They were never at that stage going to qualify as chartered accountants or become university professors or lawyers. So that was their way that they could get in, establish a base, and maybe they made sacrifices for the generations that came after them.
I always find it fascinating hearing about people's upbringing and what kind of made them who they are. I wanted to know on the non-personal finance side, right? What's a personal decision outside of investing or money that ended up shaping your financial success the most?
When I look back, there were some key decisions that I took. I was very interested in economics. I managed to get a job offered by a local authority to work in their economic development department. I almost took it, but in the end, I made the correct decisions of sort of going into accountancy, which was to some of my friends was a bit of an odd choice because I was quite a radical in those days, and it seemed very conventional to join a big firm. It was a top 8 firm of accountants at the time, but really bringing together those economics, the skills I got from economics, and really being interested in that as a subject from quite early on, from 16 onwards, I was studying some form of economics, and combining that with the accountancy and going out when I was training to be an accountant and visiting lots of different companies. One week it could be a software company, the next week it could be an industrial company in Barnsley, and meeting sometimes founders of businesses, very entrepreneurial, and sometimes you would meet sort of professional managers who had worked their way up a big organization and seeing the differences in their approach. And also puzzling about obviously part of the audit role is to check whether the company's been fiddling the books and presenting a rosier picture of the business. Okay. And I was always really very good at trying to work out whether actually things were quite on the level. And there was something we had called an analytical review where we used to bring together all the little tests that we used to do. And there you would analyze the business and you would analyze the balance sheet and such like. And, I didn't realize it at the time, but all those things came together to make me a much better investor at the end of the day. So I would say that decision and not going down the other route is probably the key decision that has allowed me to be a better investor.
Right. So going into accountancy, actually having experience, like not infiltrating, but reviewing companies' kind of like accounts and having a better understanding of their like financial performance, you feel made you a better investor? Because as an investor, you have to have some level of understanding of that when
you don't have to be an accountant to be a good investor. And you don't have to have done economics to be a good investor. I know lots of good investors who've got a background in a whole range, civil engineering or some kind of manufacturing, but I think for me it was very helpful. You know, I've always been quite financially orientated and good with numbers and things like that.
Yeah. As you were saying it, I did think that actually, you know what, this is why you're a good investor. When you were saying it, before you said it, I was thinking, yeah, it definitely is, because as like you say, right, and you'll talk more about like what makes a good investor and how you can become better as one. I also wanted to, you know, I read, right, that you started, you know, investing in your teens. What inspired you to invest? What were you investing in, and how did that first investment perform?
Well, my grandfather used to own a few shares, and my uncle, again, got quite busy. They weren't, I have to say, they weren't particularly good at it. And my father, who had never invested, except on one occasion where a more distant relative phoned him up and said, "This is the deal of the century. You've got to put all your savings into this." This was in the late 60s. You know, he'd only just built up some savings, having come here in 1956 and set up a business. And he put all his savings into this investment. And 2 weeks later, the company went bankrupt. So I suppose that was quite, you know, that had an influence on me as well. I didn't want to sort of make those mistakes. But so I was interested in shares and from my teens, and I used to just keep a model portfolio. You know, I used to come in and check the prices every day, even though I didn't actually own the shares, but I sort of put together a portfolio. I can't say my analysis was particularly sophisticated. You know, I might have read a little article about them in the newspapers, but it was a start. And then I began investing, as you say, probably at around 18, 19. I had an account, and then again was in and out of markets. I got involved in the government privatizations of the 80s and did well on those. It was hard not to do well on those. But then got more serious about it in my early 30s. Okay. What
made you think this was for you? Because obviously your dad had a kind of a traumatic experience, right? Losing savings. Why didn't that make you scared and be like, "Oh no, I'm not gonna do that. I don't want to lose all my savings"?
I don't know. It's strange. I suppose there's.
Rebel? Is it rebel in you?
I found the area interesting and exciting.
Right.
And I suppose, you know, although I've been involved in some entrepreneurial activity, my real success has come from investing. And I think it just lends itself better to my skill set. You know, I'm very analytical, and I think that really helps when you're looking at companies. So, you know, I think you just naturally flow in the area that you find that where your skills are.
Okay, that's interesting. It's always nice to hear what like drives people to do what they do and become so good. And it's amazing that you found something you were good at such a young age, and then you've been able to continue doing it. I mean, you must have a real passion for it, still doing it till today.
Yeah,
you know?
I do. And it waxes and wanes. I mean, there's periods when I've been less interested in the market. So between about 2001 and 2007, I didn't do very much. And arguably over the last 4 years, I've done less. And I'd like to think it's because I naturally switch off when there's fewer opportunities around, when I'm feeling the market's not going to reward me for my effort. Yeah. And I switch back on when I see a lot of opportunities. I hope it's that. And I hope
you might have some opportunities soon.
Maybe.
Go with the way the world is going on right now. You never know.
Yeah. Well, periods of volatility like this are always interesting because there are chances to buy things that are much cheaper than they would have otherwise have been. And people tend to sort of get suffer from irrational exuberance and get carried away to the upside and being too depressed about things on the downside, and being able to sort of just act in a not overly emotional way, but calmly and rationally think, well, is this going to lead to the World War III? I don't think so. Therefore, let's take advantage of this and buy into concern, by investors' concerns.
Yeah, exactly. And as they say, like being an investor, you have to be like an optimist, they say. to be a long-term
I think you have
investor?
to be an optimist, but the market teaches you humility. So, you can't dominate the market. You can't tell it, I want to be a millionaire by this age and it will deliver. No matter how hard you work, it's not going to happen. If the market goes the other way, then it's going to be very difficult for you to meet your objectives. So you've got to also accept that you might be wrong. And a lot of people have various biases in their nature where they don't really want to accept that they could be wrong. And we see it a lot in religion. People are fixed in their views. They don't really want to open themselves up to other views. But you can't bring that tool set into investing because you're going to be ashamed. You're going to embarrass yourself pretty quickly. So if you're too confident and too aggressive, they're great skills necessary to build a business. You can use your force of personality to build a business that's under your control, but they're not necessarily the traits that are going to lead you to be a good investor. Because in an investor situation, you're typically not in control of the business. You own a percentage of it, but you're not in control. Therefore, you've got to make assessments about the quality of the people who are running it day to day and their integrity and their ability. So it's a different skill set to entrepreneurship, but nonetheless, there's a crossover point as well between the two. Yeah.
Okay. And we're going to talk more about it because I really like your assessment of what you said in terms of, if you're quite aggressive, it's not the same as in investing, because actually that aggressive mindset could actually, like you say, you can put all your money in one thing and it could just go down to zero and then you've kind of lost everything, right? In a way.
I mean, dogmatic belief combined with an aggressive personality, I think, is the fastest way to get to zero if you're investing. Okay. I mean, some people will get lucky and it'll come off, but for most people, I don't think it's a sensible approach.
Yeah. Gosh. Navigating the world of investing can feel like driving in a new city without a GPS, confusing, overwhelming, and full of wrong turns. That's where Lightyear comes in. It's your financial GPS, clear, intuitive, and always guiding you towards smart opportunities. With Lightyear, you can grow your cash or build wealth on its simple to use platform, earn 4.34% AR in vaults powered by BlackRock money market funds, or open a cash ISA with 4.25% AR interest, all in one place. Want to build wealth tax-free? Lightyear Stocks and Shares ISA gives you access to thousands of international stocks and commission-free ETFs. Stock trades are capped at just £1, and with a flat 0.35% FX fee at the mid-market rate, there are no hidden surprises. You can even transfer your ISA in or out easily. On Lightyear, you'll find clear, simple information to help you invest with confidence. For ETFs, there are breakdowns showing exactly what's inside, from company holdings to fees and regions. With individual stocks, you'll see analyst price targets, up-to-date news, a dividend calendar, and key financial metrics. And if you're worried about security, Lightyear UK is FSCA authorized, and eligible customers are protected by FSCS for up to £85,000 in case of platform failure. Remember that this doesn't cover investment losses. Signing up takes just minutes, so you can get started straight away. Try Lightyear using my code SAVVY or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account when depositing at least £100. Terms and conditions apply. Remember, investing involves risk and the value of your investments can go down as well as up. So when we spoke offline actually about this, you were saying to me, I know that you in 1993 you opened your first personal equity plan, and I've mentioned personal equity plan on the podcast before, and that this is it later became the Stocks and Shares ISA. Can you explain what these are and what benefits they offer to people?
Yeah, so the personal equity plan came in 1987, and then also a single company PEP or personal equity plan that was introduced at around the same time. And I think the limits at that point were £6,000 you could put into a PEP and £3,000 into a single company PEP. The single company PEP was a lousy idea because let's say you did really well and the shares went up tenfold. Now you got £30,000 in your single company PEP, and in those days that was a lot of money for me. And then you could only stick it into one other company. You sold that investment. You had to put the whole of the remaining amount in another one, which is crazy. You might want to split it into 2 or 3 or something like that. You weren't able to do it. So that was a PEP. And what the PEP and latterly the ISA provided was the ability to better roll up gains tax-free. So the concept is you use your taxed cash from your earnings. You don't get any tax breaks going in. There's a limit on how much you can put in each year. The benefit is that any gains you make from buying and selling shares are tax-free, and the dividends you receive are also free of tax. So it's an amazing product. If you can compound tax-free, you're going to make a lot of money. That really is a unique opportunity. And the other benefit is that when you take money out of the ISA at the end, or whenever you choose, you're not paying any tax on that. So it's quite different to a pension or a SIP where you get the tax relief going in. You can still build up tax-free, gains and dividends aren't taxed. But when you take the money out as your pension, then you're going to get walloped for tax. And if there's money left in your SIP at the end of the day, there's more taxes to be paid on that. Yeah. So I preferred the ISA style, get the tax all out the way at the front and then give me a clean run at the trying to do something with an ISA.
And not enough people utilize the stocks and shares ISA. I've talked about it many times on the podcast because you explained it so well in terms of you're growing it tax free and you can really grow it to a huge amount. But yet so many people kind of just don't even really consider cash ISAs. Yes, we know more people are putting their money in cash ISAs, but stocks and shares ISA.
Yeah, I mean, I think there's around 22 million ISAs in total. And I do have the stats, but I wasn't able to lift them off my computer. But I think it's around 4 million people have cash and stocks and shares ISAs, maybe a bit more than that. And generally, people invest in funds if they're investing in stocks and shares ISAs rather than in individual shares, or may invest in what's called an ETF, which is like an index fund that tracks the movement in the index. But yeah, cash ISAs are a disaster for people. I mean, if you think about the average rate of interest, you're going to get, 2-3%, and it's been lousy since 2008. It's improving at the moment. And then you look at the returns that equities make. I mean, in the UK, since I've been investing in an ISA SIP, PEP rather, since 93, the average return on the market is just over 7% per annum. If you'd invested in the US, I've got the figures for 50 years, but the return there has been 12.2%. The last 10 years, it's been 13.2%. And over the last 96 years, it's been 9.9% per annum. Now, you're getting nowhere near that if you're investing in cash. And the other thing about if you're doing it in stocks and shares ISAs, you're not really viewing it as your ATM. When, if you've got a cash ISA, a bit short of cash, take the money out. Yeah, exactly. Well, you're not going to compound your money in that way if you're doing that. With the stocks and shares ISA, I think you approach it with a completely different mindset. And it's that ability to be able to then compound that money tax-free over many years. And if you can get, if people have become ISA millionaires, putting in close to the maximum amount of money each year that you're allowed, but growing it by 7%, and becoming ISA millionaires, over many years. I was able to do it by putting in less money and over a shorter period because I was getting a better return than the sort of average return on the UK market.
Mm-hmm. And we're going to talk more about that because I think it's very interesting. And a lot of people don't believe you can. Lord John, and in the comments of that one, there was a few people that didn't think it was still possible in the modern day. We're going to talk a bit about that and what you think about that as well. So you mentioned, right, you said that you didn't put as much yourself. If people are thinking about putting money into, stocks and shares ISA, for example, how much should they be thinking rough amount?
Well, the limit at the moment is £20,000, but I know from my youngest daughter who works in the media sector, that's a colossal amount of money, to be putting away. So the reality is that also that when you feel free, when you've given up the party scene in your late 20s and you're beginning to think about, family and all the rest of it, you may be doing better in your career at that point. But equally, your costs are that much higher. You might be starting a family. My kids went to private school. That if I look at the opportunity cost of them going to private school, because if I'd kept the money and put it in the ISA, I tease them that their education cost me millions. But, there are these demands on your money. So reality is you're going to struggle to put very much away. Great if you can put the maximum away, and you should try and put as much away as you can. But of course, I found that quite difficult in my 30s to sort of put away very much. So, I think by around the age of, by my early 50s, I'd only put in about half the money that I could have done at that stage. Okay. And the last 5 years, I've actually been taking money out because, that's how I support my lifestyle.
Okay. I mean, you've worked hard for it, right? That's the point, right? You've grown it to that much. It's there to be used. Enjoy it. It's nice. Okay. So it's all about people putting as much as they can, but also not to, not to be pessimistic if it's not a lot at the beginning, because you can put more over time as you can contribute, as your career goes up.
And you want to start compounding early. Yeah. The earlier you start that process, the more eventually it will add up to. Yeah. I mean, people get a bit. I was doing a presentation this morning to a group of investors, and it was based upon the US returns. And over 96 years, gold in the US has returned 5.1% per annum, and shares have returned 9.9%, so double. But in reality, because of compounding, that additional 5% per annum ends up in a significantly large amount of money. So, for instance, if somebody had invested $100 in gold in 1924, that would be worth about $12,000 today.
Okay.
Had they put the same $100 into the US stock market, obviously they would be dead, but let's say a family trust had stuck $100 into a fund, that $100 would be worth just shy of $1 million. So $100 into almost $1 million, and compare that to the return on gold, which is $12,000. And all we're talking about is a 5% difference. You just wouldn't feel that difference could end up growing into such a large amount. So you really want to start that compounding process as early as you can. And even if you're only putting in 1,000 or 2,000, any amount of money as early as you can will give that money a chance to grow and give you a lot more freedom when you get older.
Yeah. Why do you think us as people struggle to conceptualize that and understand that, especially from a point of view of, I feel like the misconception that a lot of people have is they are ready to invest when they have a lot of money, rather than let's invest with what I have now, which is £10, £5, whatever it is. Yeah.
Well, I suppose the problem with investing is that it's really deferred gratification. And human beings do have a problem with deferring their gratification. True. And you only have to look at the build-up of credit card debt. People want things now. And also sometimes they've got genuine needs that have to be met now, and therefore they don't want to defer it. But if you are able to put money away, you're building up, and you invest it wisely, you're building up a real opportunity to have freedom as you get older. And also, if you look at the way that society is changing, you've got AI, you've got modern tech, you're looking at people earning, relatively small amounts of money because they can't get the kind of jobs they maybe a generation before they could get. So I suppose what I'm saying is the return to labor is under some level of threat, because modern tech is the enemy at the gate in one way, but obviously modern tech provides huge economic benefits. Now, historically, if you look at the Luddites, they were saying the same thing in the beginning of the 1800s. Oh, we're all going to be unemployed, all this machinery. But, what it allowed was for a more efficient economic system, and that created new opportunities. And so I'm not wholly persuaded that modern tech won't create a whole lot of new opportunities. But there is a risk that your returns to labor, your effort in working, is going to be reduced. And therefore, you want to be thinking, well, I need to also balance that out by having some capital. Yeah. And therefore, in the future, I envisage a situation where people will be getting benefits from both their labor time, putting in work and earning salary, as well as getting a return on their investments. Yeah. And I think that's quite important. I mean, from a broader political point of view, for that people have a stake in society. I think the danger is if people are getting a lower return from work and don't have access to capital, then we're going to have a lot of social friction in our society. And I think capitalism works best when everyone feels vested and benefiting from it. Yeah. So we've got these challenges, throughout the Western world in particular.
Yeah, it's ultimately speaking from a person that wants to achieve let me call it financial independence instead of freedom. And most of, a lot of my audience or a lot of my community, should I say, also want to achieve that. I think what you're saying makes sense, right? Almost you investing is you not only buying your time back, like people say, but you're essentially able to have a bit more of it sounds weird, but a bit more ownership in your hands of what you can kind of do with your time, essentially, like you say, right? That's important.
You want to create opportunities for yourself such that you can call your own shots. And, I think that, that is, we'll see what the impact is on AI and modern tech on people's ability to earn, a decent wage and having a decent lifestyle. But certainly, capital, I think, is going to figure far more prominently going forward.
Yeah, it'll be interesting to see what happens. So right now, approximately, there are about 4,850 ISA millionaires in the UK. I crunched the numbers against the adult population. So that's about 0.0085%. It's low, less than 1%. Why do you think there are such few ISA millionaires despite all of these, the stocks and shares ISA or PEPs, it's been around for a long time, but yet such few ISA millionaires?
Yeah, it is surprising. Well, partly because so many of the 22 million ISAs have invested in cash, and cash produces a very low return of a few percent. That's one factor. The second factor is that when people have invested, they've invested it with fund managers. And I think we're probably going to talk later about fund management. And there's a cost with fund management. If you get anybody to do a job that you could otherwise have done, you're going to have to pay them. And so that takes out a chunk of return. And also, I think that people, sadly, in this country are scared of investing. I know the Labour government's very keen to try and create a stronger retail investor sector like in America, and that allows more capital to flow into younger businesses and smaller businesses. And we don't really have that culture. I know we had the privatizations of the 80s, but people just thought of that as sort of short-term profitability, making a quick buck. And I think that all stems back to this kind of mindset in this country, which is not very pro-business. People, generally don't like talking about money, and they don't, if you have any financial success, you've got to keep pretty quiet about it. I don't know why I'm doing this interview.
Exactly.
But nonetheless, it's, and I think that lack of, people think about career, but they don't think about business very much. And because I've said the two things are linked, business and entrepreneurship and investing, if you're not thinking in that space, but you're thinking, well, how can I get up the career ladder or I want to be a doctor or a lawyer or an accountant, then again, all these things influence your approach to investing as well. And I think, sadly, it means in the end, you don't have a strong enough culture towards share ownership. I unfortunately, where there has been a strong culture, where people have been encouraged, it's all about quick, get rich quick schemes. So people look at Bitcoin and crypto, and they all just want to be as rich as quickly as possible, which I understand. We all want to do that, but it's not that realistic. And of course, the bigger the potential return, obviously, the risks are significantly higher that you're taking.
Okay, I understand. It is an interesting thing, and I believe that the culture will change. I'm seeing, and as I said to you offline, I'm seeing definitely in my community a very strong interest in investing, and I think a lot of that interest, actually, generally in investing, came through COVID when I guess people at home, they had a bit more time to explore different things, and I think with the rise of, obviously you've got like the Teslas. Tesla's another thing entirely. But I do see people more and more interested in investing. And I do hope that in the UK, we do get to that point, because you are seeing a lot of companies like leaving stock exchanges here and then going to America and kind of almost abandoning it here, because I think like they feel like they don't get the support here, But yeah, I am seeing it, and I do hope it's going to definitely change. And we do have more ISA millionaires that are inspired by this conversation.
During COVID, my young nephews got really interested in investing. They naturally were orientated to the US because they knew the US companies.
Yeah.
They were excited by that. They were some of them were somewhat reckless. They all talk a good story. Say, Uncle Leon, you don't know what you're doing, but we've got this share is going to go up 10-fold and 20-fold. Those guys are bust. They did their money, but they're young. They can earn it back. But then, a couple of them have done really well, and they've gone on to carry on with investing. And it is part of their education as well. One's doing business studies, one wants to be a lawyer, but you can see that they're developing skill sets that are going to be useful in the future, because they're having to think about these businesses they're investing. And yes, there is a preference to the US because of the reasons I've just mentioned. And you're right that the problem in the UK market is a lot of companies are being delisted, being taken over by private equity. A lot of companies don't want to come to the market because the level of regulation is too significant. There's a small company that I'm invested in. I went back to review its annual reports from just 2010, 60 pages long. Now I need to wade through 160 pages, a whole range of stuff. Mainly to do with governance and sustainability. It's all good stuff, but it takes up 100 pages. And so a lot of it is tick boxing, how do we satisfy the regulators? So it's done by form rather than necessarily genuine change. And of course, if you're a private company, you're thinking, well, look, do we want to run a business or do we want to run a compliance department? And, compliance is boring and very few people want to get involved in that if they've had the freedom of running their own business. So, we are putting businesses off listing in this country, and that's why the preference is either to go down the private equity route or find some way of listing in another place.
Yeah. Gosh, that's so interesting. I was wondering for you, on your journey to becoming an ISA millionaire, when did you first think I can actually do this? Because when we were talking again offline, you was like, getting to that first 100,000 is tough. But when did you believe, yes, I can actually get to the million mark?
Probably when I got to about 300,000. So
Okay.
if you think getting from almost 0 to 30, that's hard. And it helped that, I was able to maybe put in £3,000 a year or something like that at the time. And then getting from 30 to 300 is another 10-fold increase. But getting from 300 to a million is only a 3 times increase.
True.
And then getting from a million to a number of million again. In absolute terms, the number is much bigger, but the percentage increase necessary is much smaller.
Yes, that's true.
So Warren Buffett's sidekick, Charlie Munger, who sadly died last year, always had very pithy comments to make about investing. And he always used to say, look, the first $1 million is a bitch. And it really is. It's hard to get going, but progressively easier once you build up a base of capital.
Yeah, it is. That's the thing. It's like you say, I didn't think of it like that, but you're absolutely right. From 300,000 to millions 3 times.
Yeah.
But yeah, the way you put it like that is absolutely right. That's why it's so hard for people. And a lot of people drop off between those periods because it's like, I don't think I can kind of get there. What kept you going through that?
Just a desire, back to what we've already talked about. I wanted to prove my dad wrong, that as I hadn't gone into the family business, that I could still make it. I suppose that's a factor in driving you. I wanted there's some sibling rivalry as well, which my father actually encouraged. I've not done the same with my own daughters, I hasten to add. But all of those things drive you. And I suppose I thought this is the best way that I can achieve significant wealth. I wanted the freedom as well. I wanted a bit of get off the hamster's treadmill as early as I could. And again, that was another motivating force. So it's a combination of different things, sort of personal to me and things that I wanted to do with my life.
Yeah. And that, it's nice to hear that. It's definitely nice to hear that, because I know a lot of people in the community want to achieve what you've achieved. They want that freedom. So it's nice to hear that that was a goal for you and you managed to achieve that yourself. So I'm going to ask you this, because this is, the biggest question of the day. So you reached ISA Millionaire status in 2013. What's the story behind how you actually got there?
Well, I think, you always need a degree of luck or being in the right place. Or if you keep doing something, eventually the luck will come. And I had a number of investments that I made around 2009 after the financial crisis. I remember being in a hotel, we were away with a family, and I thought, the valuations are so low that if I really focus here, this is when I was on, I don't know, a couple 100,000 or something like that, I can really turn that into significant money. And I almost did the maths myself. I was thinking, well, that company is selling at half what I think its long-term value might be, so therefore 200 becomes 400, if you do that with enough investment. And then you think, well, hang on a minute, I only need to double again and I'm there. And then I came across one company that really helped, although it only chipped in a small amount in the rise to being a millionaire ISA holder, was a company called Bioventics, which I came across in 2012, where I bought the shares for £2.60. The shares reached a peak of £50. Sadly, they're now £26, but I have sold shares at higher levels, and I've got about 35% of my sort of peak holding in that. So that's probably not really answering your question. That helped me go from, say, the one to more. Okay. But to get to the one, it was a mixture of different investments. Okay. I mean, until around 2015, I probably only kept around 10, 12 investments in my portfolio.
Oh, really?
Because, I was working. I didn't have the time to have a portfolio of 30 or 40 shares. And also I was more confident then that if anything went wrong while I was earning money, I can sort of make good any losses. So it tended to be a much more concentrated portfolio, and I did well. In fact, there's strong arguments. I mean, John Lee is older than I am, but he still runs a pretty concentrated portfolio. And it means that you only focus on 10, 12 stocks, but you're really on it. You know those companies inside out. There's no surprises coming to you, and that gives you the confidence to hold it. I mean, my portfolio now is about 33, 35 stocks, and obviously it's skewed at the top. Okay. There's a lot more in the top ones and a lot less in the bottom ones, but that's a lot more companies to think about, and that's partly because I don't feel I want to go back to like snakes and ladders, back to zero again. Okay. Cool. So I feel uncomfortable if I've got too much. I think my biggest position is around 10% of my portfolio, 10, 12% of my portfolio. Okay. So getting those weightings right. But I think certainly when you're young, in your 20s and 30s, you've got to be realistic. You don't want to be, you don't want to be bent over a desk the whole day. And also, you remember, you're doing this in the evenings, you're doing it at the weekends. Your kids are you're wanting to go out and play and all the rest of it. Your wife wants some support and help, or your partner. So, you've got to be realistic about what you can do. And therefore, much better to focus on a few companies that you know really well. Just try and avoid making mistakes. That's key, So don't take too much risk, but try and get involved in companies where you use their products, where you're motivated by their products, where you understand that, and where that gives you the way in. Because reviewing company accounts can be a terribly tedious affair.
It can be, right?
And therefore, if you're interested in the product and you understand the product, it makes it so much easier. And most of the great companies of tomorrow are going to be the young ones today that are involved in some element of technology. And, you're much more receptive to that when you're in your 20s and 30s than you are when you're older. Yeah. So try to understand the trends. Of course, picking a winner is always difficult. They always say if you had to pick the winner from when the car industry was sort of at its infancy and there were hundreds of car companies, only one or two survived, And when you look at the internet and the launch of the internet 20, 25 years ago, a lot of those companies failed and only a few came through. So it's quite a challenge to find the ones that will be good for you. But if you find those companies of tomorrow and you stick with them, then you only need to get a few things right. Yeah. And Warren Buffett always says this, just get a few things right and you can achieve it. Because if you think about investing, you invest, let's say you have 10 investments and you lose one and it goes from 100 to 0. Well, that's terrible. But other investments might go from 100 to 1,000. There's no limit to the upside, but there is a limit to the downside. So as long as you haven't got all your eggs in just one basket, but you've got a number of baskets, and you get used to the idea of running profits, which human beings find incredibly difficult to do.
What's that? What's those running profits? So
running profits means when you're winning with a good stock, don't look to sell it. If you do sell it when it rises manyfold, just what's called top slice it, sell 10% of it, something like that. Okay. Maybe another 10% when it increases further. But generally, good companies stay good companies for a long time. And a lot of people will say they want to snatch a profit. As soon as they see a profit, they're there waiting like some kind of hawk flying over a field looking for mice. They want to grab that profit and run away and devour it. But if they find a share that's losing money, if they've got one, they can invent a zillion excuses of why that company will come good one day. And so human beings are really bad at cutting losses, and they end up cutting profits far too early. So they have what's called a skewed distribution. They have a few winners, they have a few modest losers, but they have a long tail of really hefty losses because they can't bring themselves to sell those losers. So focusing on running your profits and finding a good companies is the key, absolute key. It's called money management. So, I always think of investing as two skill sets. One is looking and finding great companies, and the other is managing your money and how to do it effectively. And by that, I mean running profits, cutting losses, and allocating your capital to the best opportunities. So you don't want a big bet on something that you really can't predict in any way about whether it's going to be a success or not. If you want to stay invested in that, great, but keep your investment at a more modest level. Try and put your money into things that you have a real insight on that are more predictable. Okay. Warren Buffett, that's why he sticks to what he knows, because he can more accurately predict the future for those companies than certain other types of investment. With a biotech investment, that only about 8% of those every new drug where they start research ends up as an FDA cleared drug. Okay. So there's a lot of companies are going to fail, and then even when they do get FDA clearance, it doesn't mean that it's going to be commercially successful. Yeah. And sometimes it can take so long to make it commercially successful that the patent runs out. So they've wasted their time from an investment perspective.
You said so many great things, so many interesting nuggets that I want to unpack a little bit. I could definitely talk to you for hours about this. So one of the things that you said that I kind of observed on was the concentrated portfolio. So you said it, and you said same for Lord John Lee on the way to getting to the million. So, and then now that you're there, you decide actually, let's diversify, because actually at this level, even a 5% loss is it could be have a huge impact on your portfolio. Would you still, if you were know what you know now, that concentrated, because many people think diversity, even if you're not at that level, at low levels, let's say between £0 and £100,000 investment portfolio, you should be relatively diverse. Is that still your thinking, or is it concentrated for a little bit and then start diversifying?
I've outperformed the market. Most fund managers, probably 85% of them, underperform the indices over, say, a 15-year period. And why do they underperform? Well, they're carrying a whole lot of costs, these fund managers, which I don't carry. And there's also institutional rules about how much they can only hold 10% in one stock. So if they have a brilliant, great multi-bagger stock, they have to keep trimming it. But the main problem is that they're trying to collect assets. So that's how they make their money. They charge 1% on the total amount of assets they've raised, which means they tend to have very large portfolios, particularly at the smaller company end. You can't get the money into the stock, so you end up having to hold 300 stocks. You can't know them very well. And so, diversifying there, it's presented as a positive, but actually it comes as a result of sort of certain institutional rules and habits that make it very difficult. Right. And actually diversification really is, they call it diversification, because you're progressively getting into businesses that you know less and less. And again, if you haven't got time and you haven't to analyze 30, 40 companies, plus the ones that you might buy, and you haven't got a whole research department, you've got to be realistic about what you can achieve. So better to have laser-like focus on 5, 10, 12 stocks and try and make your return there. I mean, I've done well with that approach, and also particularly well in smaller cap companies where the accounts are easier to read, where you can get to meet management teams much more easily, and you can form a view about them. The businesses generally are easier to understand. There's fewer skeletons buried, and you're more likely to find them if they are, in a great big insurance company. I mean, who knows what could happen tomorrow? Sure. So focus on, I think focus if you can on the small cap world, and you've got the ability to be able to get in. If you make a mistake, you get out. If you're a big institutional investor, you buy a 10% stake in a small company, you're stuck. If you've got it wrong, you have to wait for somebody to buy the business out, or wait for the company to go bankrupt. So, that's why I'm a big fan of people investing directly, but also why I think that excessive diversification is a bad thing. Okay.
What is too excessive?
And certainly 100K, I don't think you want to be heavily diversified. I know it might seem like a lot of money, but if you work it out on, well, what kind of pension will that buy me? Well, it'd be about, I don't know, $4,000 a year. That's not going to pay for very much. So 100K, you want to be setting your sights up here and not worrying so much about what could happen if you lose it. Okay. Because you might be able to earn that back if all your investments went to zero. You might still be in the game if you want. But I think go for it, but in a sensible way. But don't make life hard for yourself.
Well, do you think it's too much diversification? Is there amount too much? Is it something?
No, I think it's relative to the size of your portfolio. Okay. At my size, 30 probably makes sense. It's probably over diversified in truth. Okay. But it means I can sleep at night a bit. When I was at 100, 200, 300, I think I had about 5 or 6 investments.
Wow. Seriously?
Yeah.
That would have freaked me out. 5 or 6.
Well, the problem is, one thing I forgot, if you end up owning the market by being over diversified, which is what most fund managers are, you end up only achieving the market return. Yeah. True. Now, in the case of fund managers, it's the market return less the cost of compliance, paying the fund managers, all the rest of it. So actually, that's why 85% of fund managers in the US underperform their benchmark over a 15-year period. It's actually a bit more than 85%, because they've got this drag on them. Whereas when, as a private investor, you don't have, you're only going to get the market return if you over diversify. Okay. Yeah, actually, when you put it like that, that does make that is what it is. Isn't it? Even there's some economic theories about how many stocks you hold. It means you end up effectively taking the market risk. So there's sort of what do they call it? There's specific risk and general risk, and essentially, if you own too many stocks, you remove the specific risk. However, you also remove the opportunity to outperform. You know, and I wanted to do better than the fund managers. Otherwise, why am I wasting my damn time?
That's true, exactly.
I may as well go on the beach.
Yeah, exactly.
You know? So that way, and just give the money to those guys to manage.
Yeah.
So I wanted to do better than that. And I think to do better than that, you know, you have to take some educated risks.
Oh, gosh, so interesting. Do you remember over the 32-year period how much you roughly invested per year? Like,
well, I was thinking about that. I mean, I invested, I think, no more than 150k into each of our ISAs over 20 odd years.
150k in. So you and your wife's ISA, right?
So 300,000 over about
really
25 years, something like that.
That's it.
Yeah.
Oh.
You know, my ISAs are worth more than they were in 2013. I'm not going to disclose what.
Yeah, I know. Yeah.
So and now I've been taking money out in the last couple of years. I've now effectively taken out more than I've ever put in.
Yeah. That's astounding. You see, this is the thing. When I say this, people don't understand the power of this. So you put in 150 over 25 years. Okay, each.
Yeah, I'd say to around 2019. I think was the last time I made it.
Let me get my calculator quickly. 25 years, 150,000 divided by 25. It's about 6,000 a year. It's not a hefty amount.
And that was skewed towards the end of that period because in the early part the limits were much lower, only $6,000.
So you put in more later on in the journey.
Which is contra to what I said is sensible. You should be trying to put as much as you can in to give it a chance to compound early on.
Wow. I'm really shocked at this because it's shocking because again, when we talk about investing, your proof of why it just makes sense to just invest what you can. Don't worry too much about trying to get a higher salary and, okay, I'm going to just try and put in 10,000 lump sum here, 10,000 here or whatever. Just snowball up as much as you can. And your journey proves that works. You don't need to worry too much about, okay, I can't afford to put in the max, like you say, every year.
Yeah, I don't think you did. I mean, with 20,000 limit, not that many people are going to be able to hit that.
Yeah.
So, put it what you can, but be consistent about it. And feed money into the market, gradually. Particularly if you're not making your own decisions, but you're putting it with either fund managers or with index trackers, then putting money in on a monthly basis and buying a few more units is not a bad way of doing it.
Yeah.
But certainly investing in an ETF for most people probably makes more sense than investing in a fund manager for the reasons I've explained, because they're much lower cost.
Yeah.
And also you get the benefit of they're not subject to behavioral biases in the same way that a fund manager might have. Fund managers are humans like us. They make bad decisions. And with an index, as a company's market capitalization declines, it sort of drops out of the index. So that means your fund, they sell that stock. Whereas, and it's something up and coming and doing really well, they have to include, and it becomes part of the index. They have to buy into that stock. So you're naturally replacing poor companies with improving companies. Now, you might not be able to do that as easily if you were left to you to decide, because you might say, oh, I think that company that's dropped out of index, that might come back one day. I think it's good value, and you hold on to it. Whereas with index funds, they don't have that. They're not subject to that same behavioral bias, and they're not subject to the very significant costs that one associates with fund managers.
Yeah. Huh. So you mentioned before one of your investments that did well. What was that percentage?
Biventix.
What was the rough amount return that you got on that?
Well, in terms, it started at £2.60. I bought in at £2.60. I bought more at £4.20, more at £6. So sometimes the directors, or there was a private equity firm involved, they were selling down, and I would sort of buy it each time. I don't mind buying into a higher price. Some people make the mistake of always looking to buy into a lower price, but if the share price is rising, well, it's telling me that the company's delivering on what it said it was going to do. It's making the profits it said it would, and therefore the share price appreciates to reflect that. And you probably got more information as well by that stage. So I don't mind paying more for something if I know more about the company. And then it rose up to as high as 50. And as I said, back to about £26. The company was called Bioventics.
So we mentioned obviously that you built a multi-million ISA and SIP actually, portfolio over, if I didn't mention that to everybody, portfolio over 32 years with an average annual return of 16.7%. That's more than double, right? In the UK anyway, right? Per annum, all while working full time, which is, you kind of alluded to it a bit before that you were also working full time. What was your investment strategy or approach that helped you achieve such consistent above average results, especially in where people have, it's not a perception, it is true that a lot of people don't beat the market. So how were you able to do that?
Very early on in in fact, I forgot to say it at the outset. You said, what was the thing that really made a big difference? And it was getting to be aware of Warren Buffett and Charlie Munger in the 1990s when I was still in my 30s, and understanding their approach and how they thought about investing. So it's not just a roulette chip. It's not a gamble. You're buying a percentage, a small percentage, but a percentage of the company, and that you want to buy good companies. And even if it means paying more for a good company, and a good company is the companies that generate high profit margin, that make a higher return on the money that's been invested in that business. And that therefore generally means that it will generate more what's called free cash flow. And that free cash flow can be used to grow the business organically, can be used for acquisitions, or it can be given back to investors. You don't want to be invested in very capital intense businesses where just to stand still, they have to claw back half the cash that's generated just to keep the business at its current level. So I think that investing in quality franchises, because you're only as good as the company you keep. So my focus is that I want to be with good quality companies. Obviously, you want to buy them at a sensible price, and that sometimes can involve a lot of waiting for the company to be priced attractively for the benefits you're getting.
I wanted to elaborate on your frameworks. So you said cash flow, right? Is there any other kind of criteria frameworks that you look for when you're looking to invest in a business?
Yeah, so I like companies that generate higher returns on capital. We're talking sort of 15 to 20%.
What's higher returns on capital mean?
Well, it means you essentially take its profit before interest and tax, and you divide it by the total assets less current liabilities. That's one way of doing it. There's various approaches to it. One particular measure I use, it hasn't caught on in the world, but I like to use it, is called ROTA X, which is to take profit before interest and tax and remove from the balance sheet any goodwill that arises on acquisition or intangibles that arise on acquisition. Goodwill is essentially where a company buys a business for 100 million, but actually it only finds 10 million of assets there, net assets there.
Really?
So essentially, which is very common because you're buying into the profit flow rather than the asset base of the business. So, there you've got 90 million of goodwill and intangibles and 10 million of assets. Now, I like to take that out. And so I'm looking at the balance sheet, looking at those assets that are used day to day in the business. So, the machinery, the debtors, the stock, etc. What return am I getting on those assets that need to be replaced from time to time, but are being used day to day? And that's why I call it a return on total assets, excluding goodwill and intangibles. And I like to see a return of 20% on that. And that's telling me about how capital efficient the business is. Cool. If the other measures, which include the goodwill, is telling you how effective, what's the return been on management's ability to grow the business, including acquisitions. So it's also saying how astute were management in the acquisitions they made. Because if they've paid all this extra goodwill and yet they're earning a tiny return on it, then they've been
not as shrewd as they sound.
Wasting a lot of capital. And a lot of acquisitions tend to be more about the management's ego and their share plans than it is about growing real value for shareholders. Acquisition orientated companies tend to be higher risk. I'm not saying you shouldn't do it, but generally I prefer companies that grow organically.
Yeah. Huh. That is, I like some of your, I think you also mentioned to me, you like, in terms of margin, right? There's certain, is there like, do you prefer companies that have high margins? I know it's different depending on the sector, but
I mean, what's a high profit margin telling you? It's showing you've got some pricing power.
Yeah. Okay.
It's also, and particularly in inflationary times, you want pricing power.
Okay.
And we're probably heading towards a greater inflationary environment going forward. So you want companies that can pass that cost on. So it's telling you something about the quality of the business. I mean, I always remember being presented to by some guys who said that they were world leaders in nuclear decommissioning, and they generated about a 1% profit margin. And I thought, well, if you're world leaders, you're clearly not able to premium price, because you're only generating a 1% profit margin. So this has got to, every Tom, Dick and Harry's got to be doing this nuclear decommissioning, or whatever you're doing in the process isn't at the high value end of it. It must be at the lower value end. The company went bankrupt because ultimately, they were projecting to the stock market strength and quality, but the numbers told you something quite different. And the profit margin of 1 or 2% is screaming out to you that this is a low quality business. So look for businesses that generate high profit margins and high returns on capital and good free cash flow, because the free cash flow is like the blood circulating through the body. It's giving you the power to be able to move forward and grow the business. If you're not generating the free cash flow, you can't grow the business, and it's going to stagnate. So you need that free cash flow. So there's profit and cash flow, and profit is a measure developed by accountants to try and make the whole thing very accurate by saying, well, if someone spends 10 million on a piece of capital equipment and it's useful for 20 years, well, we want to apportion it over that 20-year period. But profit is not the same as cash. Cash is what keeps a business alive and allows it to grow. Okay. And so that's why my most preferred metric is sort of looking at a company's free cash flow. Okay. And sometimes, I won't get, I don't want to wade through 165 pages of an annual report. Thank you very much. Especially when 100% of it's compliance related and bores me stiff. So, what I often will do is just look at those three statements: the cash flow statement, the profit and loss statement, and the balance sheet. Okay. And then I'll decide whether I want to invest time in reading it up and learning about the business. Because if I'm finding it's a low profit margin business, well, what's the point?
Yeah, there's no point in wasting all your time on it.
Yeah. Time.
So it's like your quick check.
Yeah,
on it.
And if you do that, and I've drilled that into my mindset. I mean, I deal with some very, very smart people who've got much bigger bandwidth than I have, and they like to get sucked into all the detail, and they use that fantastic brain they've got they waste it because they can't work out what's important or not. And so much better, you don't have to be a genius to be good at investing, but you need to know, you focus on what's important and recognizing what are the most important things. Those three things I've mentioned, and also the quality of the management team and the integrity and the honesty of the management team. Yeah. Those are pretty essential things, and they tell you a lot about other things. If you've got an management team with integrity, generally the corporate governance is going to be good. You don't need a 100-page report to tell you how good it is. It will be good.
I want to talk about the other side of investing. Even though you become an ISA millionaire, what would you say have been your biggest investing mistakes?
Yeah, I've made plenty. And I'll tell you, the worst mistake is the mistake you keep making. Everyone's going to make one mistake first time, but it's criminal to keep making the same mistake and again. And from time to time, I have made the same mistake a second time. I've only lost more than 100 grand on 2 investments, and it still kills me that should have happened. And in both cases, I hadn't done enough work. I relied on friends who said, I think this is a good investment. And, I did the work afterwards, after the businesses didn't do very well. And I thought, what did I do wrong? And when I began to understand those businesses in greater detail, I realized that I was never going to do well with them because I hadn't fully understood the story. But that's not the only type of error you can make in investing, where you buy something for X and you have to sell it for Y. The other is where you fail to sell a very profitable investment. And I've got quite a few examples of that where 100,000 is nothing. I've lost, in that sense, from where I was at peak to where I was when I sold. I've lost a lot, hundreds of thousands of pounds.
Okay.
And that's quite hard to live with. There's a company called Best of the Best, which some of your viewers may have seen, where you have to identify where the ball is on an image of a football match. And if you get it come closest, you win a car. And it's a great business, really charming CEO. I bought it for about £2.40 initially and bought more at £3 and such like. Always liked it and got on well with the management team who I could meet. And then during COVID, the business took off. Absolutely took off. You might remember this business, and some of your viewers might remember, it was a business that was based in airports. And they used to have a swanky car and sell tickets.
I've seen it myself.
Initially, the tickets were really expensive, like £100 per ticket. But with the dawn of the internet, they started selling most of their tickets online for a few pounds. And of course, that led to the business really taking off initially. But during COVID, it just went ridiculous because people had time on their hands and were bored and wanted to have a little gamble. And management ended up selling a whole load of shares at £24 to financial institutions and others. So that's up from about £2, a number of years earlier, 10-bagger. And it then carried on rising. I think it got as high as £36, which is a colossal position. And what had been a modest-ish size, maybe it was a top 15 position, suddenly became my number one position. I did sell shares on the way up in the mid-teens and also some in the mid-30s, but I didn't sell enough. And eventually the shares came back. I sold some more at £9. They came back to £3. And then the company was sold in a most ridiculous situation. I won't go into the detail, for about £4.20 a share. So from where I was at maximum, which was in April 2021, when the shares,
maximum?
It's about £35 for the share, to where I ended up with my sales both going up and coming down. It went from being a colossal gain, in excess of £1 million, to being a much smaller gain. So, and those losses are difficult to cope with, particularly as in that case, I actually thought I knew and understood management. And so that was a humbling process to realize I'd got it wrong.
Yeah.
They weren't quite the people I thought they were. And they had they'd been telling the market, well, this increase that we're seeing is not due to COVID, not really. It's due to the fact that we're now wholly on the internet. Well, that already happened. And so they were trying to merge the two things together, which was slightly disingenuous of them. But, people have got to make the money where they can.
Right.
And they haven't done anything criminal. And so, but it was annoying for me because I misjudged that, misread the situation, even though I had little things kicking off in the back of my brain saying, well, hang on a minute, that doesn't make sense. But I didn't act on my instinct.
Yeah.
I greed, probably, because it's usually greed, then persuaded me, no, there's more upside. This business has fixed costs. This business could grow to £50 a share, £100. So, and we're all susceptible. And even though I've been doing it 32 years, I'm also susceptible to it. And you've got to really say to yourself, well, actually forget the upside. The upside I always think takes care of itself. What could go wrong here? And I didn't apply my usual approach in that scenario. So, I didn't lose money on the investment, but I lost money from where I was.
Yeah. You lost money in terms of what it could have been for you if you sold there. What would you do differently for your next investment in that situation?
Yes, you do need to learn. And actually, you learn more from your mistakes than your gains. You pass your gains off as brilliance on your part. You don't even think about them. But the losses, the market educates you, and the costs can be very, very high to become educated in the investment market, because the best lessons are the most painful ones. So what can I do in that context is really not to get bought in to a situation where I allow, as I said, greed to overtake common sense. but trying to keep that balance. It wasn't a disaster. Other people ended up, going all the way up and all the way down, and it's still overall one of my more profitable investments.
Okay.
So, I'm.
Yeah, because you did manage to sell. As well,
and so, it was, but, my portfolio hasn't got back to that level overall that it was in April 21 when the shares peaked at that price.
Right. So, wow, it was that big of a jump. I mean, actually the number you said is crazy. More than 10x.
Yeah.
Wow.
Yeah, it was worth a lot of money.
Wow. So you mentioned one investment that helped grow your portfolio. Are you able to mention another one? Well?
Yeah, I mean, a couple that, one, a boring one called Beazley. They're a non-life assurance company. I've owned that share now for 15 years. And had different, sometimes I've had more, sometimes I've had less, but it's been a permanent feature of my portfolio. It's a very well-run insurance business. Insurance businesses essentially make money partly from the money that they're holding. So, if people pay their premiums, they hold the cash, they invest the cash, they get a return on that. And a lot of insurance companies make money only from that. But Beazley and also some other efficient ones keep their costs very low. And they can also make a profit without having to rely on the investment income. So, and generally, they might have, for every pound of revenue, they might have 50p of cost, 30p of payments back to the people who've taken out the insurance policy, and as much as 20p in the pound of profit. So that makes quite an attractive business model, but that will fluctuate from one year to the next. Those shares I bought for about £1. I remember I bought it at below book value, tangible book value at the time. I've had lots of dividends on the way up, but I've had a lot of return elsewhere from it. Another company that people will have heard of is Nintendo.
Oh yeah, of course. Yes.
I bought in in 2012, still hold it today. And that company it already had its success with the Wii product, you might remember, Wii Tennis and Wii Football and all that stuff. And then they introduced an updated version of that product, which flopped. And the share price collapsed, and I bought Nintendo at below its cash value. So it's a Japanese company. Japanese companies generally are very conservative managed. They tend to have far too much cash on their balance sheet. But I took the view that this business has so much cash on its balance sheet and such a good franchise that even though this product will be wrong, they'll eventually get it right. They'll eventually find some way. And of course, a number of years later, they came out with the Nintendo Switch as one of the most successful gaming consoles ever. They've just launched the Switch 2. So again, it's just the way you approach an investment and think, well, look, I'm buying this at below the cash on the balance sheet. That's a ridiculous proposition for a big brand. And is the product dead? No. They're just trying to work their way through and work out how to get it right. Yeah. So, it's a risk in one way, but in another way, you're not taking a risk because of the cash and because of the strength of the franchise. Yeah.
Leads me on to my next question, right? So again, talking about the other side, I think the other side of investing is just as important as the good and the wins, right? So I was looking back, I asked ChatGPT to figure out how many major stock market crashes would have happened in your journey. I think it was roughly about 6 to 8 major, potentially. What motivated you to keep investing during those tough times? And out of all of those years, which was like the real hardest for you?
I don't know if there's certainly been 6 to 8 whilst I've been interested in investing. Starting from the one in 73, but I wasn't invested at that time. But what keeps you in? I mean, actually, I get quite excited when we have major stock market sell-offs because so many opportunities come forward.
Yeah.
Because everyone's rushing out. The exit isn't big enough to cope with everyone who's desperate to get out. So you get some real opportunities to buy bargains. And so that can be quite exciting. But I think the trickiest year was 2020, the year of COVID, because we suddenly saw stocks collapse dramatically in late March. I think the market was down about 20%. And, 20% of a reasonably big number, is not nice.
Yeah. 1 million to 200K.
Yeah. And so then but by the end of that year, it was one of my best ever years. I was up 43%. So that variance from minus 20 in March to plus 43 by December. I mean, I know the Chinese proverb, we live in interesting times. I can do without that kind of interest. Mm-hmm. But of course you can't, as an investor, stipulate, I'd like returns to be a nice steady 10%. The world doesn't work like that. I think the key thing is you've got to somehow mentally detach yourself from the value of your portfolio. Otherwise it would be too difficult and you'd end up with panic and fear, and you won't be able to think straight, and you start making bad decisions. I'm not saying I will never ever be in that position, because who knows? Mm-hmm. But I suppose I've been blooded, in the sense that I've gone through at least 4 big downturns, and I've seen 2 others, the 1987 and 1973. So I think I'm battle hardened, to use that cliche, in terms of, but who knows? The real test is, could be ahead of me.
Yeah. One thing that you said offline that I really liked, you said with investing, you have to have the right temperament, which I really appreciate you saying that, because I think it's so important. You have to be calm. You have to almost kind of be stoic in a way, like on both sides, right? Like, yes, gains are happening, but you can't get too excited about that. In the same way, when things are going bad, you can't panic too much. You just have to be quite militant with what you're doing and kind of back yourself on both sides,
Yeah. It's, I think temperament does play a role, and you've got to try and find the style of investing that fits your personality best. I mean, if you're kind of a person who likes constant action, then, trying to invest like me is going to kill you with boredom. You're not going to like it. So maybe you've got to try and hone your trading skills, look at charts and say, hey, I think if the shares have now gone down below a particular threshold, I should buy. If that's what gets you interested and excited, I know Lord John Lee well, and we probably have a similar temperament. We tend to think long term, and we tend to be relatively calm. I'd say John's even calmer than I am. But you've got to make sure that you've set yourself up in a way that you have got some protection if it all goes to hell, because that will be difficult to manage. So again, if you're investing in businesses that don't have much debt, that generate a lot of free cash flow, that have pricing power, they're unlikely to be sunk by a recession. If you're buying into marginal businesses that, they could be gone, So by investing in quality businesses, you've got a greater chance of coming through relatively unscathed.
Yeah. What do you think are important, personal and technical skills that would help somebody be a good investor?
Yeah. Well, as I said earlier, you don't have to be a genius. Common sense is obviously important. I know John Lee talks a lot about patience as being the most important thing, and that's clearly a factor. But I think that you, in terms of technical skills, I think you don't need to be a chartered accountant, but you do need to have a brain that allows you to see clearly what's important. Try and narrow it down, drive out all that erroneous detail, try and get to the key points and what really matters. Don't get so carried away with some aspect of their technology that you can't see the bigger picture. Yeah. So try and focus. And if you've got a mind that does that, I mean, I hate boring stuff. So, I would just, as management are talking, I can feel myself wading through a forest. Right. I don't want to know about that. I don't want to know. And people are sometimes surprised at some things I haven't retained from a meeting because that's gone. Yeah. I want to use up that valuable space I've got for what's really important. So I don't know how you train yourself to be like that.
I think it's experience, right? It sounds like
experience. Yeah. The other thing is relying. Instinct is a bad thing as long as it's based upon all your acquired learning to date. So, that's what I think really gut instinct is. It's that accrued knowledge that you've built up over time. You've met dodgy finance directors or dodgy CEOs or dreamy CEOs who think they're going to conquer the world but aren't living on this planet. And then you meet that character type again, and you suddenly think, oh yeah, something tells you, you're saying it's your gut, but really it's your brain having processed all the previous times you've had dealings with people like that. And then you think, well, and so rely on that. And going back to the point, don't be therefore greedy and override that natural instinct, because 9 times out of 10 you're going to be wrong by overriding those instincts. So they're kind of non-technical skills that are really useful, in terms of looking at, as I said, if you do a very basic course in understanding how a balance sheet, a profit and loss, and a cash flow can be read and understood, and what ratios are important, that will be a great help. That really will get you invested in the right type of companies. And you do need to work hard. I mean, it is putting in the hours after you've done a hard day at the office, going home or at the weekends and doing some extra work. So, the last few years I've sort of not put as much effort. I moved to a nice place by the sea, and, it's great fun walking along the seafront and all the rest of it. And you don't get as good a return. Whereas those friends who've stayed completely focused on the market in the last 3 or 4 years, even though it's been a difficult market, they've done better than I have because they've put the work in, and I can't really complain, if I'm enjoying life and everything, so.
That's interesting. No, I appreciate you giving that insight, because it is important to say that, like, even at your experience level, you still do need to put in effort to kind of get that. On that note, I wanted to ask you, if you were to start your journey again, on your way to become an ISA millionaire, but you wanted to do it quicker while managing risk, what would you do differently, do you think?
I wouldn't do anything different. Okay. I would do it at the pace that I did it. I think if I tried to do it faster, I would have not achieved my objective. So I think that's where patience. Yeah, sure. I if I could, I'd like to have put more money into my ISA earlier and tried to max out and find every way of trying to do that, even at the expense of my daughter's education. I'm joking, but no regrets whatsoever in terms of the way I went about it. I've got some, as we discussed, some investing mistakes that I've made that have scarred me, but actually the pace that I did it at was about as if you try and push it too far, you're going to lose money. You can't take too much risk, and you can't, as I said right at the outset, you can't set an objective. I'm going to be an ISA millionaire by this age, because it depends on how much you put in and the returns you're going to get. And you can't always determine what returns you're going to get, because the market might tell you what returns you're going to get for a particular year. You could set out saying, I'd like to do 12% per annum this year. And then there's a war and stocks sell off and, you're minus 30%. What you do, what can you do?
There's not much you can do, right? Yeah. As I mentioned before, towards the beginning of this conversation, many people don't think it's possible to beat the market in today's world. I would kind of argue and say that, but at the time when you started, you took a risk. It's not like you had a crystal ball to tell you that it was possible. Same way now, there's no crystal ball to know in the future. So what's your take on that? Do you think it is possible?
Well, I remember thinking in the early 80s, my parents were a lucky generation, the post-war generation.
Exactly.
They bought into property, and all that property's gone up so much, and and we can't afford anything like that. And I was completely wrong. It didn't matter, because new opportunities came around, and there were new property booms, etc. after that, which I was able to benefit from. So I don't accept the fact that there aren't new opportunities. I think at the moment we're seeing lots of opportunities. I mean, in March, when Trump announced his tariff, my portfolio had never been valued so cheaply. It was trading on just 9 times the weighted average PE ratio. PE ratio is a key measure in investing. It takes the share price and divides by the earnings per share. Now, usually my portfolio might historically trade on a PE of 15 or even as high as 20, was trading at 9.5. So if I'm looking at a portfolio with valued at 9.5 times on a PE basis, I do not accept that there's no opportunities. In fact, opportunity has arrived. That's the way I look at it. And you need to take these moments of turmoil. I mean, all of human history is subject to turmoil. So you've got to take these moments to try and buy some good quality investments. I bought Microsoft for the first time.
Wow.
It's up 35%, since I bought it. And I like Microsoft. I think it's great business. And I'm now a shareholder. And so seize the day. Generally, if everything's trading on crazy multiples of their earnings, or the fact that if there is no earnings, they're rated incredibly highly by reference to their sales, then that isn't an opportunity. That's a potential pitfall that you're going to end up losing money over time. So wait for the market to come back to you and seize the day. As Buffett says, when markets are flying, be fearful, and when they're in the doldrums, be greedy.
Yeah.
And it's just common sense.
Are there any investment opportunities that you're looking at yourself that you're interested in?
Yeah. So at the moment, probably the share that's giving me most grief at the moment is a company called Novo Nordisk.
Yes, I've heard of them.
Which was a share I bought in around 2017 and had gone up about 6 or 7-fold for me. And it does the weight loss treatment, Wegovy. And they're competing with Eli Lilly. And there's been concerns about how effective their treatment is compared to the Lilly treatment. There's also concerns about Trump maybe trying to cut back on the amount they're spending on medicines. It's a Danish company, and Trump's obviously said some things about Greenland, which is owned by Denmark. Maybe he'll take it out on this company. So the shares, which peaked at $145 in the US, are now trading at around 65, something like that. But it's a business with a very high profit margins. Its main business is providing insulin and treatments for people with diabetes. And that's not going out of fashion. Those stats are rising. My personal feeling is you're actually buying the business purely on that basis and not the more controversial weight loss. You're almost getting that given for free. And the market is sort of looking at lots of short-term things saying, this treatment is reduced weight loss by 23%. It's not as good as Eli Lilly. That's 25%. Well, does it really matter? 23% sounds to me pretty effective. And maybe they can, and they've got so many different lines of research going on. Okay. You can use the same active ingredient that's in some of these weight loss treatments and diabetes treatments to deal with a whole lot of range of inflammation. So it can be used for, and also for things like Alzheimer's, possibly. There might be a solution there as well. So my feeling is it's a very profitable, cash generative business. They're going through some difficult times, a bit like Nintendo was 13 years ago. They're doing a lot right, some uncertainties over some areas, good opportunity to buy. You're buying them on probably the lowest price to earnings ratio that they've been. I think it's like something like a 14 or 15 times valuation. A PE ratio is saying how many years worth of profits is the company valued on. It's valued at 15 times the level of its current profitability. And that's, for a high profit margin business, that's not bad.
Amazing. So my final-ish question to you is that for anybody that's new to investing, that wants to start, where would you say is the best place for them to look? And what's the best starting point for them?
Yeah, well, read a few books. Anything on Buffett will do. And that will help you understand what's important. So you start off with the best education possible. He's the world's most successful investor, and start off. He never wrote a book, but a lot of people have written about him. And you can take it up further than that. You can read Ben Graham, who was the key influencer of Warren Buffett. You can read his material, and it'll really help you understand. I trained to be an accountant. I said it was important, that training, but actually my education wasn't complete until I actually read Ben Graham's book, and I read the books written on Warren Buffett. That really was the completion of my education in thinking about the investment world. So read some books. There's organizations like ShareSoc and Mello. You can look them up on the internet that organize events where you can go and meet companies. You can see presentations by them. You can mix with other private investors, and they're not all old like me. Some are young, and you get a chance, to get, so you can make it a social type of exercise.
Yeah.
The last thing you want to be doing is beavering away in a darkened room on your own for years and years. So make it an interesting experience, listening and learning from other people. Keep with good company. Keep with people who are going to lift you up, who aren't going to be envious when they see that you've done well in the stock market. So you get as with stocks, get the losers out of your life early on. Go with the winners, because the winners, I prefer to be the thickest person in a room.
Yeah.
If I'm the smartest person in the room, I don't want to be in that room. I want to be learning from the other people in that room and their knowledge and understanding. So get yourself in the right kind of company, and that will create lots of opportunities for you.
Amazing. Thank you so much. Thank you so much, Leon. This has been such a great conversation, and really appreciate you sharing your wealth of knowledge. Because again, like we said, there's not that many ISA millionaires. So the fact that you've taken the time to share your experience and just really encourage the next generation of investors, I think that's amazing. And as we talked offline, it's something that you really want to actively do. So really, really appreciate that. Where can people find you if they?
Well, I have a Twitter account that had 6,000 followers, which
got hacked.
It got hacked, and now and Twitter were rubbish, or X were rubbish in getting to the bottom of it. So I've had to set up a new account with 260, but that's called Boros 10, Boros, and the number 10. Please follow me there. I'm desperate to get my profile up again. And 6,000 isn't nothing compared to the kind of people who watch your videos. I know that. But my daughter's quite impressed for an old guy to have 6,000 followers. They thought that was cool.
Good. It's pretty good. It's pretty good. Really, like I said, really, really appreciate all your wealth of wisdom. Actually, I have this question for you. What keeps you going? What gives you that drive to just want to do more for yourself and keep investing?
Partly it's a scorecard thing, isn't it? Judging is how well you're doing, and of course I've still got lots of investor friends, and and they're telling me how well they're doing. I'm thinking, God, look, I've been lying on the beach for too long. I need to start working. So that drives you. But I am very aware, and I keep telling some of my more miserly friends that, if they're just spending every hour at the computer and they're not engaging in life, they're making a terrible mistake. And I often say to them, look, John, I've got the best investment for you. It goes up every single day. And their eyes light up and they want some of it. And they say, what is it? I said, it's the value of the time you have left on this planet. It goes up every single day. So don't waste it. You've done really well with your investing. Enjoy life now. And because life's got a lot to offer, both in terms of the people that in your family and friends and the experiences. So, it's something that, I'm 63. You've got to start thinking about how you've done the hard yards. Now start enjoying it. They always look a bit despondent because they really had hoped I was going to give them this wonderful investment. In fact, I'm just giving them a lecture on how to make their to benefit from their success.
Amazing. I like that as a final word, because that was amazing. That was completely amazing, especially as you said, you're right. We have to really enjoy ourselves. At the end of the day, right? It should be a means to, we're working to a goal, right? At the end of the day, it's not just doing it for the sake of it. Yes, you can enjoy it, but it's not just doing it for the sake of it. Thank you so much, Leon, for featuring on podcast. Really appreciate you. Thanks so much for tuning into this episode of podcast. See you next week's episode.